Hi, everyone. Let's discuss how to think about investing during a recession. Are we in a recession? Everyone seems to be asking that question. Why are they asking that? Well, we've now seen two consecutive quarters of negative real GDP growth in the US. And the last 10 times that we've seen consecutive quarters of negative growth, the US has indeed been in a recession. Still, there's many who are arguing that we can't be in a recession because the labor market remains strong. And if we look at the US unemployment rate in July, it moved down to 3.5%, which was back to pre pandemic levels and the lowest we've seen in the US since 1969. And so, this debate over whether we're in a recession or not in a recession is likely to continue. It's going to continue until we get either an official announcement from the National Bureau of Economic Research, the NBER, or we see a sharp uptick in economic growth. All of this is leading to more confusion and angst for investors who have already faced what has been, if you look at a diversified portfolio, the worst start to a year in recent history. And angst is not a particularly good emotion to have as an investor because it can lead to things like panic selling, and panic selling can be harmful to the long term returns in your portfolio. So, what should an investor be thinking about as it pertains to recessions? Here's a few things to consider. Number one, recessions happen. So, as Peter Lynch said, you get recessions, you have stock market declines. If you don't understand that's going to happen, then you're not ready. You won't do well in the markets. And what he's trying to say there is that recessions are a part of markets. They're a feature, not a bug. Since 1871, there have been 30 US recessions, one every 5 years on average. And despite this fact, you have seen US equities deliver a 6.9% real annualized total return. So that's after inflation. US equities have been by far the best vehicle to build wealth over time. And recessions are a part of that because you don't have the upside without that downside, without that risk of uncertainty that about the economy, you don't have that equity risk premium being that high. So in order to have this strong long-term returns, you need to have recessions. If there were never recessions, you wouldn't have such a high return for the markets. Number two, timing isn't everything. And I think this is a big one because the temptation as investors is to say, well, if only I could get out during recessions and move to cash, I'd be better off. And historically, that's a difficult case to make if you look at the data. So I went back and looked and said, what if you're the world's best economist and you sold at the start of every recession, moving to treasury bills, and you bought back into the market at the end? How would you have fared versus a buy and hold? And you would have done slightly better if we include all periods at 10.7% versus 9.7%. But if you look at the data, that's all because of the Great Depression and the huge decline there. If we exclude the Depression, you would actually have a lower return. And I think it's important to point out that the world's greatest economist doesn't exist. No one could have timed that perfectly. And so if we look at other scenarios where you sold a year before the start of a recession or 6 months after the start, only to buy in a year after the end of a recession, you would have had lower returns than buy and hold. So why is it so difficult? Even if you were the world's best economist, even if you knew in advance when a recession would start and end, why is it so difficult to outperform a simple buy and hold? Well, it's because the stock market is not the economy. The stock market is a leading indicator for the economy. It often goes down in advance of the start of a recession and starts moving back up before the economy improves. So, even if you were able to buy and sell in perfect timing with the start and end of a recession, that's no guarantee that's going to lead to a better return because the stock market is already discounting that in both directions. And so timing isn't everything as it pertains to recessions. Number three, don't wait for the robins. I think this is a very important point because we tend to want to invest and add money to our investments when the news is good, when the stock market's up. And so there's a temptation to say today, well, maybe we're in a recession, maybe we're not in a recession, but why not wait until things improve? Why not wait till there's some type of confirmation? So if you look back in history, this really tells you why you shouldn't wait for the news to get better. So I looked at the last 6 recessions in the US, and and the return for the S&P 500 from the bottom until the point where the NBER announced the end to recession. And what we see is gains every single time and an average return of 61%. So by the time you get this official announcement that the recession's over, the market's already moved up significantly. And this a point by Warren Buffett, I think, was made back in October 2008 very well, where he wrote this famous op-ed saying, "Buy American, I am." And in that post, he said, if you wait for the robins, spring will be over. And what he meant by that was that by the time the news is better, by the time fears are gone, you're losing that chance to buy in when the stock market's discounted. You're losing the chance to buy in at lower valuations, which tends to lead to better long-term returns for investors. So don't wait for the robins. And last point here I want to make is in terms of diversification and not fighting the last war. As we know, diversification very important for investors over time because we can't predict the future. We don't know in advance which asset class is going to be the best, so we diversify. And during recessions, during bear markets, what we tend to see is correlations rise. And what that basically means is everything seems to be moving in one direction. And often during a recession and bear markets, that's down. And so during those periods of times, there's often an asset class or two that is doing well. And the temptation is, let's go all in on that asset class. Let's abandon our diversified portfolio. A problem with that is that you're often fighting the last war. If we look at the last recession and bear market back in 2020, we saw this huge spike in volatility. We saw the VIX actually close above 82, which was its highest close in history. And many investors were fearing that the worst was yet to come. And what were they doing? They were buying these products, these volatility hedges that benefit from the VIX and volatility rising. If we look at one of these products, the VXX, it had more than quadrupled at this point in just a short period of time. And again, investors are thinking, well, let me buy into this because it's got to get worse from here. The only problem was that the worst was already over at that point in time. And what we saw was what we've seen every time in history when you have this huge spike in volatility, which is a mean reversion where volatility came back down. And so over the next year, the VIX index would come back down to its historical average of around 20. And this product, the VXX, if you had bought after the fact fighting the last war, you would have lost 90% of your investment. Now, in this bear market, the big fear, of course, is inflation. And so everyone's looking for inflation hedges. And the one thing that seems to be doing well this year has been commodities, and crude oil's gotten a lot of attention because it's gotten to its highest point since 2008. And there's a temptation again to abandon diversified portfolio and go all in on a single commodity. And I would caution against doing that because once again, you're fighting that last war. You're chasing something that's already run up significantly. And so abandoning your diversified long-term plan, not likely a good idea. Don't fight the last war. Now, all of these things you're probably thinking are helpful things to think about, but you still want to know the answer. Are we in a recession? Are we not in a recession? And the truth is, there's no way to determine that based on the NBER because they don't use a precise formula. They don't have these components that they plug in and say, we're in a recession, not in a recession. It's very much a subjective kind of decision that they make based on a bunch of different indicators. But the truth is, as it pertains to investing, and as we've learned here, it really doesn't matter for investors whether someone says we're in a recession or not, and that's because the market is already discounting that. So we've seen the S&P 500 this year already go down 23%, including dividends. The NASDAQ composite down 33%, with many high growth stocks down 50, 60, 70, 80% or more. So the market is already responding, reflecting a higher probability of a recession. And so whether someone says we're in it or not, from that standpoint, really doesn't matter. But the big question, of course, is that enough? Are these declines enough? And no one knows the answer to that. And what we've seen historically is that we've had recessions like 1990 where the market's gone down less than that, gone down around 20%, less than this year. But we've seen many recessions in the past where the stock market has declined more than this year, most recently in 2020, when stocks were down over 30%. And so, the one constant of all of these examples is important for investors to remember, and that's that all recessions and bear markets of the past were eventually followed by new expansions and new bull market highs in the future. So there's an end to all of these bad periods eventually. And that should be a comforting thought for investors because historically, if you stayed the course, if you maintained a diversified portfolio, if you stuck to your plan, you've eventually been rewarded for doing so.